Thank you very much for joining us today so I can talk to you about what we're doing at Henderson International Income Trust and give you the opportunity to answer any questions that you want to ask. I'm now going to share my slides with you, and I've got a presentation which is designed to help those who don't know Hint understand it and understand what our objectives are. But for those who do and who are more interested in some of the stocks we hold, also some details there on the positioning of the fund and our outlook. So without further ado, I will share the presentation. There we go. If I'd start quickly just with Janice Henderson, if I may. I head up the global equity income team, and altogether we run about £15 billion worth of assets spread across income generating products. Some of them are higher yielding, some of them more growth and income. And that's out of, as a firm, we run 285 billion. And a lot of those assets are in the US as well. So I think people who have known us historically as Henderson are not as aware that we have a very strong team based in Denver that cover US equities. And we're very much an active management house that have been around since 90 years now. We're celebrating. So hopefully the fund and the trusts will exist another 90 years to help investors through time. But I just wanted to give a bit of background of what we do. In terms of Henderson International Income Trust, well, I actually launched this trust in 2011. And what it does is it looks for global leaders in their field that we can buy at attractive valuations, and we very much prioritize companies that have got a dividend. So the aim was to help you as UK investors to diversify yourself outside the UK, and on that basis, we're an ex-UK trust. The advantages we have from that point of view, we draw from very wide markets. And so often they're markets that are overlooked or not as accessible if you're a private investor. Perhaps you need to open accounts for that particular market, and there are some holding company costs there, or you just don't have as much knowledge about them. And we do look for companies that we buy at attractive prices. So sometimes you do find that parts of the market can get expensive and other parts can get very cheap. And 5 years later, sometimes those positions are reversed. We do run a diversified portfolio. So the idea is to help you kind of smooth your way through the gyrations of markets. So we avoid being overexposed to any particular area or region at any one time. And generally over time, I'll show you that's delivered quite smooth returns, but it does mean we tend to be not so good at capturing boom and bust type cycles in particular areas. In terms of the non-UK aspect of Hint, I just thought I'd touch on this for people. In the UK in 2023, 59% of dividends were paid by just 15 companies. And so if you diversify yourself within the UK by holding different trusts, you quite often end up with the same stocks. And, luckily, touch wood, we haven't had any big issues in recent years, but certainly for those with long memories, we'll remember issues like Macondo, certainly the banking crisis in 2007-8, when actually a lot of income portfolios had exposure to the same types of stocks. And actually in 2000, with the pandemic, what we found was the UK had quite a significant fall in income during that period, whereas the rest of the world didn't. So I think UK dividends almost halved. The rest of the world, the dividends were 92% of what they'd been the previous year. So that diversification does bring a benefit, and that's why we exclude the UK from the portfolio. If we're excluding the UK, the question I sometimes get is what are we investing in? Well, luckily over the last 30 years, there's been a really big increase in dividends from around the world from different regions. Areas like the US have quite a strong dividend culture. We produce a study that we've produced since 2009, and the US has been the fastest growing area. And within that, the fastest growing sector has been technology. So people often assume that technology stocks don't pay dividends, but an increasing number of them do. And this year, even the likes of Meta and Google have joined that list, albeit at very low levels. There's a lot of dividend coming from Europe. European stocks are both cheap, but actually they do favor dividend payments over buybacks, and so there's a lot of yield in that area. And then a newcomer to the field has been areas like Japan and Korea. Again, these were markets where management teams historically like to try and keep as much cash on the balance sheet, and we've seen government efforts in recent years pushing them to distribute that more. And for example, this shows that last year there was 10% dividend growth in Japan, and that's even in an environment where the GDP growth was much lower. In terms of how we choose between these types of opportunities, obviously part of that is dividend yield. One thing that I would say we focus on is cash flow. So as investors with a valuation bias, and some of you may also be in that camp, what the evidence shows is just buying the cheapest companies on a price to book basis, or the cheapest companies on a dividend yield basis, is not a recipe for success, because you can end up with too many value traps. What can help is focusing on the cash flow companies generating, and that cash flow, why it is important, because A, it pays the dividend to get you paid to wait if there's a tough economic environment, but I think as importantly, it helps companies invest. I would not want anyone to leave this presentation thinking that we just focus on companies with very high yields. It is very important to look at companies that have exposure to growth and can benefit from that growth. When we look at what the fundamentals that attract us, and having done this job for just over 20 years now, I think the past profitability of a company and an industry is less important than the barriers to entry of that industry and what the future of the industry is. What do we mean by that? Well, we've gone through a period at the moment, and we're still going through it, when many of these companies in what they call the Magnificent Seven in the US are investing very, very heavily, and are able to invest very heavily into new areas that historically have had quite high barriers to entry. We've all seen Elon Musk's company, SpaceX, launching satellites. They've brought down the cost of satellite launches significantly. When I first started, one of the companies we owned was a satellite company that did launches, because actually it was very hard to get satellites up. And it was a really good business to own, for example, the satellite that hung over the UK that beamed down Sky. Nowadays, we can get Sky over cable, we can get Sky over broadband, and also we're seeing this increased proliferation of satellites because the cost of launching them has fallen. So, that's a good example of an industry that was quite a nice dividend payer for a long, long time, but has been really tough over the last decade. And it's key to be able to not just look at the past profitability, but how people are investing that money, and whether those barriers to entries are falling or whether they're getting stronger. A sector where we feel barriers to entries have got a lot stronger over the last 6 or 7 years, and last decade, arguably, is the technology sector. We have seen companies build up really big moats, as Warren Buffett calls them, by investing heavily at a point where other people have fallen away, and they've been left as the leader due to intellectual property. So actually, barriers to entry can take many different forms, and it doesn't have to just be a brand. So these are some of the things that we look for when we're looking for actual stocks underlying. I would say, we are value investors. I think probably for us, value is not just the cheapest stocks and the highest yields. You can see here, though, this shows the trends between MSCI World Value and MSCI World Growth. You can see for large periods, for example, in the 80s, in the 2001 to 2007 period, when the line is going up there, value type stocks are performing well. You can see there in 2001 was the technology bubble of that period, and in that period, technology did very well, which is when that line is going down into 2000, and then it reversed very quickly the other way. You can see in 2019 to 2022 and 2016 to 22, we saw a really strong outperformance of growth And so these were companies, like many of them startup companies, many of them not necessarily profitable, but growing very quickly in new areas. There was a sharp rebound towards value in 2022, and then it's gone the other way again as AI has come to the fore. So, the long-term trends, would indicate that there's an opportunity for investors to look outside the Magnificent Seven. We'd agree with that, but we would also say you have to be careful, because on some of those things we said earlier, the barriers to entry to some industries are falling because of these technological changes. In terms of the portfolio and what we're doing in the portfolio, if we get into the nuts and bolts of that, what this chart shows you, and there's a lot of numbers here, so it's partly to help us answer questions later if you have any. You can see here on the left-hand side of the chart the geographic weightings of the portfolio, on the right-hand side the sector weightings, and then the orange dots are where we've changed that weighting over time. So the orange dot is where it was last August, and then the blue line is where it is this August. What would you pull away from this? Well, one, we have a high yield, so 4.7% there is the trust yield. Two, the portfolio valuation at 13.7 times price to earnings ratio is a lot cheaper than the MSCI World. Our index is actually a high yield index, but people often at the moment are talking about the US market being quite expensive, 22 times price to earnings ratio. And so I just wanted to show that this portfolio, which is very diverse, is a reasonably valued portfolio, despite the fact that we have the biggest sector weight in technology. So one of the big changes we made from last year was to increase the technology weight, because we see two things there. One is some very interesting developments within artificial intelligence, but two, actually large parts of the sector have been on a downturn for several years, such as smartphones and PCs, and they may be starting to come back. The other area that we've liked for a long time actually is financials. We've liked financials because when interest rates were very low, it was very hard for financial companies. So the ones that were managing to generate profit and do well were doing very well, and would benefit when rates went up. We've had those rates going up significantly. Financials have done very well. We have been taking a little bit of profit there. On the other end of the spectrum, people do ask us about sectors such as real estate, utilities. We've had a lower weighting to those over the last few years. We've been a little bit nervous about what happens when interest rates go up quickly. And lo and behold, interest rates went up quickly, and these sectors have been, at best treading water, and in some cases, have seen quite a lot of their value erode over the last few years. And that's due to two reasons. One is leverage. So these higher interest rates are making it harder for companies that rely on debt to grow their business and to make the business work. And if they locked in very cheap debt, as that debt is becoming more expensive, it's become a bit problematic for them. So that gives you a little bit of a feel of where we're positioned and how we've changed over the period. And probably the biggest other change that we've done there is the reduction in energy. I think a few years ago, I felt OPEC was in quite a strong position with regard to controlling energy prices. Certainly, I think we've seen over the last few years, even though we've kind of come out of the COVID period and we're traveling again, we're not seeing so much of a benefit in terms of oil demand picking up, and we're seeing quite big inventory in the storage. So energy is an area that we've reduced over the last year, even though it's a high yielding area. So one of the key things, again, I'd like you to take away from this is we don't have to invest, because we're a global trust, in just the highest yielding areas. We can look for other things in other markets when we want to avoid some of the higher yielding areas that we are a bit nervous about. In terms of performance over time, this chart shows you the performance of Hint since launch. That's the blue line. This is the net asset value. I quite like the quote at the top: predictions very dangerous, especially if they're about the future. It's been ascribed to Yogi Berra, who was a baseball player who had a lot of amusing sayings. But I think even before that, it came from market commentators back in the 1800s. The point of it is, ever since launching Hint, these events have happened, and when we launched Hint, we never thought they would happen. We didn't in any way anticipate COVID-19. We've had a number of kind of in the early stages of Hint's life periods where people are worried about the sustainability of government debt, a little bit like we've had here in the UK over the last 12, 24 months. And despite that, the portfolio has created value and grown net asset value, and it's grown the dividend over time. What I would draw attention to here is we do have the ability as an investment trust. One of the attributes that we have is that we can borrow on your behalf to enhance returns. We can borrow up to 25% of the value of the trust. And you can see this, the bar chart down the bottom shows that we've used that leverage at times to take it up towards 16, 17% leverage when we see there being particularly attractive opportunities. Quite often, we've done that in a counter-cyclical manner. What does that mean? Basically, when markets sell off, we've tried to take opportunity of that with that leverage. I'd say, in this last year, we have had a lower level of leverage. And whilst that's been right in some markets, it's definitely been wrong in the US. We looking back with hindsight, we should have had more exposure to markets, and the US market particularly. One of the things that held us back there was our conservatism. So, when interest rates go up very quickly, you can end up with quite big sell-offs in markets, and that we have been a bit worried about that. So we've sort of got it half right in that we've avoided areas that have sold off, like real estate, but we've missed some of the upside that have come from what has turned out to be a much stronger US economy than I think we could have hoped for. So it's been good because the US if we looked on the previous slides, is our biggest market, but it's been, you can see here, 37% exposure there to the US, but it's been less good because we could have done even better. At the moment, we're waiting to deploy that leverage. What I would say is, a question I get is, are we impacted by higher interest rates? And actually, back in 2019, when rates were very low, we took advantage of that to issue very long-term debt into some people who wanted to get that kind of exposure. So we issued 2.43% debt for 30 years into the European private placement market. So we have about 8% of the trust that we can invest, and that it has got a very low rate of interest. One of the things we're very proud of at the trust, and is one of the key objectives of the trust, is to provide a growing dividend for investors over time. Why is this important? Well, God willing, we all live ever longer lives in retirement, and inflation very much has the potential to erode returns from fixed income. So when you buy bonds and they pay you interest, or if you put your money in a bank and it's paying you interest, you can come back 10 years later and find actually that interest buys you a lot less than it did. The aim that we have with Hint is to help you offset that inflation over time and try and maintain your purchasing power. And so since launch, we had a 4% yield at launch, which was 4 pence on a pound. The first accounting period was a short and a long one. And then we've grown it consistently over time. And so, that we're very proud of this. We've just this year received from the AIC a next generation dividend hero kind of classification. And the board is very keen to keep that going through time. Again, really from an investment trust point of view, one of the big advantages we have is that we can smooth our dividends by investing, by taking dividends earned in good times and spreading them over bad times. But also we can use capital reserves sometimes to distribute if we feel the best opportunities are elsewhere in the market. In terms of the top 10 here, I'm not going to dwell on these. I'll come back to them if people want to. The main points is the top 10 dividend growth for last year was 6.5%. So that's August to August is our accounting year. And the portfolio average dividend growth was 10%. And it's come from a real range of companies across different sectors and regions, as you can see here. In terms of where we're investing at the moment, I thought I couldn't really do this presentation without talking about technology. It's such a big topic at the moment. It's our biggest sector, and we don't own all the Mag 7 stocks. So what is it that we're owning and why? Well, at the moment, we're in the process as a kind of society and economies of really building out the infrastructure for artificial intelligence. And that started even before we had this recent trend of artificial intelligence. We've seen generally a broadening out of the use of technology from being less business to consumer. So people like us, getting Netflix and having smartphones. And it's been more about companies like Siemens being able to track their engines and turbines and everything real time to see whether they need fixing rather than having to send somebody out to fix them all the time. It's very much now people getting their data in the cloud. So one of the key things we see at the moment is companies, they can't really use AI unless you have your data in the same place. And that's really what we're seeing at the moment is a big proliferation of figuring out how we use artificial intelligence. And to do that, it has to be in the cloud. And that's why companies like Microsoft, which we own, are benefiting. But it's also why companies like Oracle, which we own, companies like Honhai that make the servers, which that are being put in, are benefiting as well. So there's a wide range of companies that we think are due to benefit from these trends. But what I would say is what this slide is designed to show is that these waves do last a long time, and they can have a number of different stages to them. So the first wave that people talk about is mainframes in 1950s to 70s. The second wave is the internet. So certainly for me at university, we had access to one computer each, not one computer up in the library per about 500 people, and that changed very radically over my time there. And then more recently, the mobile and the smartphones, and now we're really moving into this area where we're starting to see other applications coming. In terms of around the world where we're seeing it, I would say the biggest excitement we see by companies is very much in the US and in Asia. The excitement is slightly different for different companies. In the US, they are very excited about the productivity improvements they think can happen due to AI. I think for the rest of the world yet, they're still trying to figure out how to extract those, and they're not quite as positive. And then in Asia, particularly in Korea, in Taiwan, in Japan, they're excited because they're building all the equipment to do AI. So the two big areas that we see that are benefiting from technology at the moment are there. When we come to Europe, it's more about changes in energy. So actually where the excitement in Europe has been much more about is the transition away from fossil fuels. It used to be in order to bring down CO2, and now it's much more to do with energy security, and away from, and that requires a massive amount of investment, and that investment it often uses engineering and industrial companies. So, we're seeing industrial companies benefiting within this as well, because they're the ones who are helping us kind of transition to be able to have smarter electricity grids. So I wanted to give a bit of a feel here. There are different drivers in different parts of the world driving technology. It's not all necessarily AI. In terms of performance highlights, we've generated over a decade of dividend growth. We have a 4.4% yield as of just a couple of weeks ago. The last 12 months return to the end of October was 17%, slightly shy of our benchmark. And I would say, we have been slightly shy recently of the MSCI World. I would hope over time we can close that gap. Certainly in 2022, we proved to be very defensive when technology sold off. I think we see a lot of very cheap companies in the world, but I think we need to see some of the geopolitical issues falling away, and maybe interest rates coming down before people start to be a little bit more confident. So hopefully that's what we start to see next year, is interest rates coming down make it a better environment for countries all around the world, including in emerging markets, to start to perform better. I am going to stop there, and I'll just allow any questions.
Thanks very much for that, Ben. We've got a couple of questions so far. Can I just remind delegates that if you'd like to ask a question, please click the Q&A button at the bottom of your screen, and you can type in your question. So the first question from John is, what have you learnt since becoming manager of Hint, and how has this affected your strategy?
Yeah, well, I launched it, and the biggest thing, John, that I have learned is that past profitability is not necessarily a good indicator of future success. I think the level of disruption in industries has accelerated in my time in markets since 2000, and actually just gets quicker and quicker. So I think that's the main thing I'd say, is that the kind of buy and hold kind of strategy for long periods of time, I think, has become harder, because actually companies are seeing their industries change more and more quickly than they used to.
Thanks, Ben. And then another question from John. Which geographies do you think will deliver the best performance in 2025?
It's a really hotly debated topic. I think, in terms of potential for the greatest upside, it does lie within, I would say, Asia, and particularly China and Europe. I would caveat that by saying that, it might take 6 months before we can really feel that confidence. And the reason I say that is, Mr. Trump is going to be inaugurated in January, and between now and then and after then, we are going to get a flurry of threats around tariffs, and generally that's going to keep people being very nervous from investing in exporting markets like Europe and China. I think, like, once we're through that, and if interest rates are coming down, then actually there'll be quite a lot of benefit for those economies. So I do feel long term they are where the value is. I would say probably short term, the US is going to be a safer bet.
Thanks, Ben. Then we have a question from Sean. Is the dividend fully covered by revenue? And if not, what is the view of the board as to its sustainability?
Yes, it's a good question. So the dividend has not this year been fully covered by revenue, and the board has adopted an approach that it'll be predominantly covered, but they are willing to use reserves to allow us to invest in some areas that don't have as much income at the moment. For the life of the trust, for the first decade, we spent time building up reserves. But actually what we've found is, the rules around that changed, and the feedback from investors that they'd like to see the income pass through more quickly. So we've moved away from necessarily building up reserves. We still do have some revenue reserves, and we've moved now into the stage where, we'll use realized capitals and profits in the past if necessary, up to a point. The aim is, though, to provide a progressive dividend through time. So, we do want to keep growing the dividend over time, and it is sustainable in that way.
Thank you. Then we have a question from Julian. Okay, no, so that's essentially the same question, so we'll just skip that one. Then Matthew is asking, how do you see the future of the European economy?
Yeah, I see, I see a brighter future for European companies than I do the economy. I think I almost feel in the current environment in all regions that 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 companies actually are more likely to endure than governments at the moment. And I think you can see that in the credit rating. So some country bonds yield less than their respective. So some company bonds yield less than government bonds because people are more confident that they will exist and pay back their debt than some countries. In terms of Europe, I think it is quite difficult because they're gonna face a big threat around the tariffs, and they're gonna have to figure out whether they act on that together, or whether they see certain parts of different interests competing. I think the most important thing that needs to happen for Europe is this conflict in Ukraine coming to an end. So I think in a way, if I can paint you an environment next year when the conflict comes to an end and where oil prices are low, because Mr. Trump very much wants oil low, he wants to produce much more oil in the US. I think actually that will be better for European economies very quickly. And then if you can get China growing and China stimulating, that would be very much better for European companies. So I feel like the success of European companies for the next few years will be more about the external factors than anything that the European governments do themselves.
Thanks. That's very interesting, Ben. And then finally, we have a question from Sean asking about why the board haven't instituted a buyback as the discount of your shares to NAV has been growing.
Yes. For a long time, the trust traded at a premium through to about 2019-20, and it has traded at a discount. But the board's, the board does look at this, and it looks at it compared to other trusts and the industry. And I guess what it doesn't want to do is find that it's buying back shares to no avail. And in recent times, with interest rates being higher and sentiment being lower, we've seen discount rates across the industry open up. And so the board is looking at that, they're analyzing that. In the first part of assessing whether to do it is to decide whether it would make a difference. At the moment, they don't feel that the discount is sufficiently wider than than equity trusts in general to justify that buyback.
Thank you. We'll have one more question from Tom. Longer term, what will be the balance of companies' basic dividends and special of the companies, I presume, basic dividends and special dividends?
Yeah.
Hints lower earnings last year made reference to fewer special dividends.
Yes.
How do you model your longer term earnings and dividend growth?
So we tend not to model special dividends, and we welcome them when they come. We do look for cash generative companies with strong balance sheets. So we quite often do get special dividends. I do feel that the outlook for special dividends has declined in recent years. And that's partly because more companies are trying to appeal to both income investors and US total return investors. And what they're doing with their excess capital is they're doing buybacks. So I think whereas in the past, we used to see in markets like Europe and the UK, we would see special dividends from the likes of Rio Tinto if they had more money than we thought. We're now seeing them, including the banks, prefer to have like a 50% payout ratio or a 60% payout ratio, grow that dividend, that core dividend, with earnings over time, and then reward you with either buybacks or specials otherwise. And there's a bit of a movement towards special dividends. And I would say the regions that we're seeing that as well now, the region that didn't used to do either of those things, that used to just keep the cash, was particularly Asia, and we have seen there an increase in dividends, but we also seen an increase in buybacks happening. So I think companies are getting a little bit more American in that way. And you'll see quite solid underlying dividend growth that is designed to be sustainable. And probably when they have excess capital, more often you'll see buybacks. For us, a few years ago, part of those special dividends were because of COVID. So actually, during COVID, a lot of companies were forced to hold back their dividends because of the government telling them to. And what we saw then was they came back, and we were holding a lot of companies because we thought they would come back, and they did. And so I think that period is now largely over, and it's more about the underlying dividends.
Well, thanks very much for that, Ben.